Hi, I'm Art Bergeron, and the presentation you're about to see is the one that I had taped for a presentation in Ashland in April. This one is all about taxes, especially the ones that especially affect seniors. We're going to talk about the capital gains tax, the tax that you pay if you sell your house or if you give your house to your kids and they sell it. But we're going to talk about the estate tax, the tax that gets imposed if your assets when you die are worth more than $1 million, which is often true if you have a house or tax deferreds. And we're going to talk about the income tax, which does affect you if you're pulling out any of those tax deferred funds, whether they're IRAs or 401ks. So we talk about how you may want to think about dealing with all of those so as to minimize the tax, and how the way you think about it may be about to change as a result of potential changes in the threshold amount that would be charged if you above which you need to pay a Massachusetts estate tax. So we're going to talk about all of that. If you've got any questions on any of this, please give me a call. The number is 508-860-1470. Thank you. Hi, I'm Art Bergeron. Welcome to the fourth of 12 seminars, which I've generically called Elder Law 101. This is all about taxes. Don't be taxed by taxes. This is part of a 12-part series that I've developed to really summarize everything that you as a senior or your kids need to know about elder law. We've already talked about my friends Frank and Mary, about thinking about estate planning before your 60s. Then we talked about issues important to you in your 60s. Then we talked about issues important to you in your 70s. That was January, February, March. This month, because everybody thinks about taxes, it's April, I decided that I would do one of the two presentations dealing with a specific topic, which is taxes. Next month, I'll be talking about living life in your 80s. Then why you can always qualify for Mass Health. Then the last year of your life, which is going to happen. It may be happening to you right now, but it's going to happen. Then what happens after you die, kind of a post-mortem, talking about probate, other things. Then trust administration, because so many of you have trusts. The question is what happens to those trusts after you die. Then talking about estate planning, how dealing with your kids, in particular, and your grandkids. Then we're going to have the two more of these specialized presentations. We're going to talk about Medicare in November, when all of you should be thinking about Medicare. We're going to be talking about gifting and tax plan and other tax planning issues that you think you should be dealing with now, but you really were supposed to have dealt with back in December. So we're going to talk about all those things. So we're always talking about my friends Frank and Mary and their kids, Peter, Paul, and Mary Jr. Their goal in life is very simple. They want to live in their house until they die. They want to be buried in the backyard. They want to leave everything to their kids. When they were younger, they wanted to make sure that they also avoided probate. That may still be important, but they definitely want to avoid taxes. Nobody comes into my office that doesn't say that part of their plan is they want to avoid paying taxes. So today is just about taxes. Now, I always talk about Frank and Mary, but in this series I've also introduced Mary's sister Peg and her daughter Peggy, a single person, and her individual daughter. In this case, Peg and Peggy are worried about exactly the same things that Mary is worried about and that Frank's worried about. So I'm using two different examples when I talk about these issues, because as many of you know, I work primarily in two different areas. I work out here in Metro West, where I live, which is in Marlborough. So do a lot of work in the boroughs and in Hudson and Hopkinton, Ashland, these communities. I also do a lot of work on the islands, on Martha's Vineyard and Nantucket. For those of you who don't live there, you don't realize that whenever I'm on one of those islands, I always have to refer to the other island as the other island. A lot of those people don't really like each other. But the point is, they have a different situation, or if I'm talking to you right now, you have a different situation because of your house. So in my example, Frank and Mary own a house, and out here in Metro West, it's worth $400,000. And out on the islands, it's worth $1 million. Same house is worth about $1 million or more. The other numbers, though, are the same. Frank has an IRA, it's worth about $400,000. They have joint savings worth $300,000. They have some mutual funds worth $400,000. So out in Metro West, that adds up to an estate of about $1.5 million. On the islands, that adds up to a estate of about $2.1 million. And we're going to talk about the set of tax issues and how they may affect these players differently, but conceptually the issues are the same. I'm going to start off by talking about capital gains. We're going to talk today about a set of different taxes. And by the way, I tried consciously to keep the numbers on these slides to a minimum, because when I'm talking about taxes in general, and more specifically when I start talking about the numbers, people's eyes glaze over and they're like, oh, this is way over my head. So I want you to get, the point of this presentation is to conceptually get how these issues are connected. I realize your situation is unique. Everybody's situation is unique. And the way these numbers would affect you, therefore, is unique to you. All I'm suggesting here is there are some things that you want to be talking to your accountant about or your lawyer about to figure out your goal. And the goal is not to minimize a particular tax. The goal is to minimize your total tax. Does you no good if you've minimized the estate tax, and as a result of that, you're paying a boatload more in capital gains tax. The question is kind of what's the net? And you want somebody who really likes math and who does this stuff and who is consciously aware of, especially on the federal level, the changing rates of taxation in order to help you figure this stuff out. So first, we're talking about two kinds of federal income tax. One is the regular straight income tax, and the other is the capital gains tax. And actually, this tax is both federal and state. Capital gains tax is the tax that you pay, very simply, if you bought something for a little bit and you sell it for a lot. The difference between what you bought it for and what you sell it for is if you're selling it more than a year after you bought it is a capital gain. There is a tax on that capital gain. At the federal level, that tax is around $15,000. I'm going to, once again, kind of keep this rounded so that we can keep the numbers simple. The state capital gains tax is a flat rate, and it's around 5%. So the total capital gains tax for purposes of this presentation, we're going to talk about as being 20%. How do you compute the capital gains tax? Well, first, by figuring out the capital gain. What is capital gain? Capital gain is adjusted sales price minus basis. Adjusted sales price, well, you know what sales price means. It's the amount that you sell it for. For purposes of capital gains tax, though, the issue is adjusted sales price. That is the sales price minus like the real estate commission, minus your real estate lawyer's fees, minus any work that you had to have done on the house in order to get the house ready for sale, minus all the things basically that it costs you in order to get that house ready for sale. So that's pretty obvious. The next question is, what is basis? Basis is a made-up term, right? It is only relevant. I mean, you thought you knew what the word basis was. It has nothing to do with this. This is simply a word that was made up in the Internal Revenue Code, and then in the Massachusetts Code, all other codes have adopted it. So the question is, what does it mean? Well, it's something very straightforward. It means if you bought the property that you're about to sell, it means your purchase price plus the cost of the improvements. What can I take as improvements for purposes of doing this adjustment? Talk to your accountant as to whether or not replacing the roof is really an improvement as opposed to painting the house, as opposed to, I mean, there are a million things that you can think about in the house and say to yourself, so what are those improvements? And by the way, the next question is, if I'm about to sell that house, how do I figure out the price of those improvements? If you worked on the house, no matter how much your sweat equity, it counts for zero in terms of doing the improvements. If you paid somebody to do the work, or if you paid for supplies or whatever, all of those are part of the improvements. But once again, you want to talk to your accountant about this. By the way, one other thing, when you're going to sell your house, oftentimes you'll talk to your accountant and say, well, how do I prove what those improvements were? And you're thinking you're going to need to file all of that when you file your income tax return. Actually, that's not the case. When you're filing the return, you're simply going to have a number that's going to say, here are the improvements, right? If you get audited, then the government is going to want to know how you figured out that number. So your goal is going to be to have documentation that you feel is adequate in case you get audited, okay? So if you're selling and you simply bought the house and now you're selling it, the price is purchase price plus improvements. If you bought the land, and this happens occasionally in the Metro West area, a lot on the Cape and Islands, because a lot of people bought the land or inherited the land or got it gifted to them, then the basis is the cost of the land, what you paid for the land, plus the construction cost of your house, plus these improvements. What if somebody gave it to you? Or what if you inherited it? In that case, your basis is the basis of the person who gave it to you. Anytime that a person makes a gift of appreciated property, property that is now worth more than what their basis was, what they're giving the basis. They're not paying a tax at that time. I know in many countries, I know specifically, I've been doing some work in a case in Ireland, where if you make a gift of appreciated property, at that time there is a tax that is owed on the difference between what you bought it for and the value of it when you're giving it away. Same thing is true if you inherit property in Ireland. That's not the case here. If somebody gives you something, there is no tax as a result of that. There is no income tax as a result of that gift. There is also no gift tax, and we're going to talk about that a little later. But the main thing, there's no income tax. But the point is, that's your basis. So the question is, if your mother gave you the property that she inherited from her mother, right, then the basis was the value of the property at the time of the inheritance from her mother, for reasons that I'm going to go into a little bit later on. If your mother bought the property and is then giving it to you, your basis is whatever she bought it for. So, basis in that case, if you receive the property as a gift, is the basis of the property when it was given to you. Or excuse me, the basis of the property was either what the person who gave it to you bought it for, or whatever their basis was because they had inherited it. And there are the capital gains costs. So, if you're Frank and Mary in Metro West, and you go to, and say you're about to sell your house, and say that you bought the house, and remember in our example, their house is worth $400,000. Say their basis, say they bought it, but for whatever reason, their basis in the property is $100,000. Say they bought it for $100,000. They sell it for $400,000. Their capital gains tax would be their capital gain would be $300,000. Normally, they would pay a tax based on that $300,000. Remember, we said that the capital gains tax is about 20% of the gain. Therefore, their tax would be $60,000. However, as you all know, if you have been living in the property for some period of time, then you get a capital gains tax exclusion. That exclusion is $250,000 per person. So in the case of Frank and Mary, you would say they bought for $100, they sold for $400, their capital gain was $300. Their exclusion is 2 times $250,000 if they've both been living there for a period of time, and therefore their capital gains tax is 0. So the question then is, I just want to go back for a second. How do you qualify for the exclusion? So you qualify. That's the rule. If you lived in the property for 2 of the last 5 years, it makes no difference if you've used an exclusion like this before. For many of you who are older, you'll remember, you'll have it in the back of your mind, that back when we were younger, there was a cap on this. You could only use this exclusion once. That's no longer the case. I literally had a family that had 3 properties. They lived in Framingham, here in Metro West. They had a house on the Cape. And the husband had inherited a house in Ohio to which they were going to be moving because they had a lot of family in Ohio, etc., right? So what they did was they sold the house in Framingham, which they had bought for a little and were selling for a lot, but they were able to take advantage of their exclusion, so they paid no capital gains tax. They moved to their house on the Cape. They lived there for 2 more years, Remember, you only have to have lived in it for 2 of the last 5 years. They lived in it for 2 years, then sold that property, which had appreciated a tremendous amount because it was a little cottage that they had bought years ago, paid no capital gains on that, took all their money and moved to Ohio. So you once again, you want to talk to somebody about, what the implication of the capital gains tax is going to be for you. Now, if you're Frank and Mary, we went through the example. If you're Peg and you live in Metro West and you bought that same house for $100,000 and you're selling it for $4, your capital gain is $3. Her exclusion, though, she's single, is only $250,000. Therefore, the net capital gain is $50,000. The tax is 20% of that, or $10,000. Now, say you're Frank and Mary on the islands. You bought the house for $100,000, same house, but now it's worth $1 million. This is not an uncommon situation. On Nantucket, that number would be even greater in many cases. But say it's worth $1 million. Your capital gain, therefore, is $900,000 minus the 2 exclusions, $250 apiece for $500,000, means your capital gain is $400,000. So you're actually paying a capital gains tax of $80,000, 20% of that $40,000. Say you're Peg. You bought the house for $100,000, you're selling for $1 million, capital gain is $900, your exclusion's only $250. Your net capital gain is $650,000. Your tax is $130,000. This is the reason why, if you're on the islands, you really don't want to be selling your property. And the reason for that is, if you hold on to your property until you die, at the moment of your death, your tax basis jumps to the date of death value. So if Frank and Mary hold the property until they're both dead, the moment of the death of the second of the 2 of them to die, their basis jumps to the current value, whatever that value is. Their children pay 0 in capital gains tax. The implication of that, by the way, is that for most people, if you possibly can, you want to hold on to that property until you die so that you can get that capital gains step up. Ideally, you want to either own the property when you die, or if it's in trust, you want to make sure that that is a so-called grantor taxable trust. We won't go into the details about that. You want to talk to your accountant or your lawyer about that, but you want to make sure it's the kind of trust where you're still going to be able to get this exclusion. Or alternatively, that you want to keep the property, and or you want to keep, if you're transferring an interest in the property to your children, you want to keep a life estate in it. By the way, regarding this example, I want you to remember, if Frank and Mary own this property jointly, and one of them dies, so the other one becomes the sole owner, the basis of the person who died, that is half of the value of the property, would jump to that person's date of death value. If the survivors then sold the house, the survivor's basis would be that jump up, as that stepped up basis as to 50% of the value, and their original basis as to the other 50% of the value. The only way that you can avoid that is by making sure that the first spouse to die owns all of the house. And we're going to talk about that a little bit more later. So before we talk about the estate tax, I want to be clear on the gift tax, because you can avoid a lot of the estate tax by doing gifting. But the question that inevitably comes up when I talk about gifting is, well, isn't there a limit on the amount that I can give? And the answer is really no. No, not for any of the clients that I have ever dealt with, no. The reason for that is this. There is no Massachusetts gift tax. So you can literally give away all of your property the day before you die, thereby avoid the estate tax. And by the way, the receipt of a gift is not income. The receipt of a gift is not income. So your children, if you give away your property, don't pay any income tax as a result of your giving them all the property. At the federal level, somebody figured out this problem, that they don't want people to give away all of their property just before they die. And so they adopted a combined estate and gift tax system. And the way that system works is that if you have an estate worth more than a particular number when you die, it's now $12,920,000, you pay an estate tax. If during your lifetime you've made a gift, you pay a gift tax, unless you're entitled to one of the 2 exclusions, the one that everybody knows about and the one that nobody knows about. The one that everybody knows about is that there's a given amount per person per year that you can give anybody you want. And that number used to be $10,000, but there was an inflation provision built into the law, so it is now actually, for 2023, it's $16,000. Everybody knows that one. Then there's the other one that no one knows, which is, in addition to that exclusion, you can give during your lifetime up to the estate tax exclusion, which is now $12,920,000. So unless that's what you're giving over your lifetime, $12,920,000, there is no gift tax. One other thing related to the gift tax. Many people will say, oh, your accountant will tell you, somebody will tell you, oh, but if you've given away more than $16,000 in a year to a person, you have to file a gift tax return. Well, the next time somebody tells you that, ask them what happens if you don't. Because what happens is nothing. Because the only penalty for failure to file a gift tax return is a percentage of the tax that you would have paid. And unless over your lifetime you're giving away more than $12,920,000, there isn't a tax. And therefore there's no percentage. So there's no penalty for failure to file the gift tax return. With that in mind, the question, if you live in Massachusetts, is, given all of the capital gains rules, especially the ones that incentivize you to keep your property until you die, and that's so that you can get that stepped up basis, what is the estate tax disadvantage of doing that? To understand that, you need to understand the Massachusetts estate tax. The Massachusetts estate tax, for historical reasons that I won't go through, gets calculated two different ways. Every time you have an estate, you calculate the tax, you figure out the tax using both of these ways, and then you pay the lower of the two taxes if you owe anything. The first way is that you look at this chart. According to the chart, which was created a long time ago, almost 100 years ago at this point, if you look at the chart, according to the chart, if you have an estate worth more than $40,000, you're going to pay a tax. It's a small tax, a very small percentage, and it's graduated. So the more money you have, the more tax you end up paying. According to that chart, if you had an estate of for example, $1 million, and I'll mention that because of the next slide, $1 million, you would pay an estate tax of $36,560. If you had an estate like Frank and Mary in the Metro West do of $1.5 million, you'd pay an estate tax of $68,240. If you had an estate of $2,100,000, you'd pay an estate tax of $111,600. That's quite a bit of money. So first you calculate the tax that way. Then you calculate the alternative tax. The alternative tax is that if you have an estate of less than $1 million, you pay zero in estate tax. If you have an estate of more than $1 million, you pay 40% of all the dollars over $1 million. So for example, if you have an estate of $1 million, using the chart, you pay zero in tax, or excuse me, using the alternative tax, you pay zero. Using the chart, you pay $36,560. You always actually have to pay the lower of the two numbers. In this case, it's zero. At $20,000, if you have $1,020,000 in estate, according to the chart, you pay $37,680. According to the alternative, you're paying 20% of all the dollars over $1 million. So 20% of that $20,000 would be $8,000, or excuse me, 40% of that $20,000 would be $8,000. You pay the lower of the two, therefore you pay $8,000. Go down to $1 million. At $1.1 million, you're paying, according to the chart, you're paying 42,000 something. According to the alternative, you're paying 40. The change comes at a little under $1,120,000. At $1,120,000, according to the chart, you're paying $45,000. Excuse me, you're paying $43,000. According to the alternative tax, you're paying $48,000. From there on in, you always pay less tax calculating it using the chart. The lines cross, as I mentioned, at around $1,120,000. So the question is always trying to avoid probate, but also trying to figure out the balance between minimizing your estate tax and minimizing your capital gains tax. For families, for Frank and Mary, there's basically a two-step solution. First, you make sure that the first spouse to die owns the property. the property can be transferred at the last minute, as long as when the first spouse dies, the property isn't simply going back to the second spouse. If it's going right back to the second spouse, and if the transfer has occurred within a year of death, then this doesn't work. But if it is being transferred not directly back to the second spouse, but in trust for the benefit of the second spouse, the house can be transferred to the first spouse to die literally the day before that person dies. When the person dies, the basis of the house jumps to the date of death value. The surviving spouse can then either give the property away to the kids with this stepped up basis, so that the kids, if they want to, can sell it and not pay any capital gains tax, or the surviving spouse can sell the house at the stepped up basis, not pay any capital gains tax, and then simply give away the money. So there is a clear way to deal with this. If you're if you're PEG, unfortunately, there is no way to escape that. I'm just going to mention one final thing, which is all of this may be changing this year, and I'm going to do another presentation on this if it does change. The governor has proposed a budget in which the capital gains tax, the estate tax exclusion jumps to $3 million. If that were the case, in Frank and Mary's case, even on the islands, there'd be no estate tax. Last year, the two houses of the legislature had agreed on alternate bills that would have increased the exclusion to $2 million. That's why I think that in the ultimate budget this year, and we're going to know the answer to this probably in August, that threshold number is going to jump from $1 million to somewhere between $2 million and $3 million. If that's the case, then for Frank and Mary, and for PEG, the issue is going to go away, because the estate tax for Massachusetts purposes is going to evaporate. So the goal is always going to be make sure that you own the property, or if your spouses, the first of the two of you to die, owns the property before you die, so that the survivor can sell the property without paying any capital gains tax at all. There were a few other issues that I was going to talk about today, but I wanted to focus on the ones that we just talked about. And if you get any questions on any of this, please give me a call anytime. My direct line is 508-860-1470. But remember, the goal of this exercise is always peace of mind. The goal of life at our age is to sleep well at night. Thanks for watching. If you've got any questions, once again, please give me a call. And I will look forward to talking to you next month. Thank you very much.